Hello, this video is for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. My name is Liz Schlemer, and this particular video is looking at how is your stock doing, but also a little bit of advice about the stock market. So when we look at the 5 topics that we're covering in this class, this is in the area of personal financial decision. So one of the things we might want to know is what's going on with the general market. Is it going up or is it going down? And one of the indications that we can use is to look at interest rates. So interest rates is something that the Federal Reserve sets, and they set one rate that is the prime, usually the prime rate, and then, or they set a couple rates associated with lending from the Federal Reserve, and then all of other interest rates are kind of indexed around that. So if interest rates fall, then savings rates fall, mortgage rates fall, credit cards fall, all of the things that have interest usually fall. So, and also stock prices. So if interest increases, then stock prices go down. And that's because there's other investments that are better than the stock market now. So the increase in interest rates, like, oh, well, it might be better than to put my money into a bond instead of the stocks. So that tends to decrease them. Also, because of the discount rate is higher, the present value of all investments will decrease. So this is a good way to think about how interest rates are going. Most people think that they probably will stay steady right now at about this Fed rate of 2 to 2.25%, and they might even go down a little bit. The next is recessions. So if there's a recession, that means companies aren't making very much money, and so the stock price will fall also. So this is a picture of the recession. The gray is the recession, that the most recent one we had. And many people think because it's been about 10 years since we had a recession that we might be due for one. So stock prices might fall because of that. Lower taxes, less regulations. I think we've seen that since Trump's become president, because he's definitely lowered tax rates and have taken a bunch of regulations. So this means that corporations can make more money, and so stock prices go up. Another thing is trade wars. So trade wars are kind of a tax on American companies. And when the trade wars are going on, more tariffs, then the stock prices will go down. So you can see there's a lot of things going up and down and up and down, and it's very difficult to figure out what's going to happen with it. In fact, I would argue that you and I, as just doing our own little investing, we have no way of understanding what the stock is going to do. We can't outguess the market. And then also, it's really important to understand this concept that markets anticipate what's going on in the future. So if they anticipate that interest rates are going to go down, then the stock prices go up. So they've already built into it a lower interest rate. So once the interest rate is announced, it's actually already in the stock market. So it really looks at people's best guess of the future, not exactly what's happening right now, but our best guess of the future. So again, I think that we don't have many insights into the way the market's going to go because we're not looking at it every day. So another question about this is to look at the stock market as either a short-term or a long-term investment. And I think in the short term, everything sort of day by day is just gambling, because we have no idea understanding what's going to happen to a particular stock, if something's going to go good or bad about it. We just don't know. But long term, the stock market has returned about 8% over inflation since the beginning. And so this is just a graph of the returns of the S&P 500, and to just indicate that it's been a good return over time. And you probably can expect that it will continue to be a good return over time. So the stock market is made up of tens of thousands of stocks, and we don't track all of them. Most of the people who track the stock market use indicators, and there's generally 3 indicators. The Dow Jones Industrial Average, which is an average of 30 of the biggest companies. The S&P 500, which is Standard & Poor's 500, this is 500 companies that are tracked over time. And then the NASDAQ Composite, which is the stocks that are traded on the NASDAQ. Now, the NASDAQ, I don't even actually know what it stands for, but it used to be considered sort of a tech company, places where tech companies or newer companies were traded, as opposed to the American Stock Exchange or the New York Stock Exchange. So that was considered sort of a riskier look at how the market is going. But nowadays, most people track all three of these. The best one that people generally indicate as the best indicator is S&P 500, but most people refer to the Dow Jones Industrial Average. So what return have you gotten on your stock price so far? So I'm going to go ahead and show you a calculation for my stock price. So this was stocks that I invested in Robinhood, and I purchased 6 shares about 2 years ago for $135 of Next Era Energy. And the reason I did that is because I manage a family farm in Kansas, and we put windmills on our farm, and they are operated by Next Era Energy. So that's just why I just thought, oh, that's great. I know this company. I'm going to go ahead and buy that. I bought them about 2 years ago for $135. Now they're at $207. That's pretty good. And they also have paid $5 per share for the last couple of years of dividends. So if I look at my cash flow associated with these 6 shares, I had an initial investment of $831. I had the 2 years of dividends. And then I have, if I were going to sell the stock right now, I would sell it for $207 times 6. And I've held it for 26 months. So I want to know, what is this return? So I'm going to look at this return. I'm more interested in an annual return than a monthly return, because monthly returns don't really mean much to me. So I wanted to calculate what is my end value. It's 26 over 12, or 2.17 years. And then I did a calculation for net present value, and I set it equal to 0, which is the way I figure out what the return is. And we haven't really talked about this, but it's the way you calculate return is in the IRR video. So, but you'll just have to take my my word for it. This is how you do the calculation. And I did goal seek in Excel to get up with 23.6% per year. So that's a pretty good return. I'm getting almost 24% on this investment. Now, I'm not going to tell you about the other investments I've made that are not doing as well, but this particular one is doing quite well. Another question you could ask is, what price should I sell at if I have a desired return? So the same example, I bought it 2 years ago. I've held it for 26 months. Man, what should I sell it for if I want a 25% return? So remember, I told you I got almost 24%. What if I want 25%? What should I sell? When should I sell it? And this is a calculation on the future value of the stock. Remember, when I did it before, I told you I was going to sell it at 207, but now the question is, what would I sell it for? So what is that future value? And I set up a future value equation to bring it to ahead to now, given that I bought it, and so this is saying that I bought it at 831, and I want to earn 25% for 2.17 years. What would that be equal to? And then the same for the dividends, but I didn't have it for as long. Both the dividends, I have it for 14 months, and then this case I have it for 2 months. And so that means that I need to sell it for $12.79, which is the same as $213 a share. So if I want 25% return, when the stock price gets to $213, I would sell it. This is another question you can ask. So you might want to say, well, which way will the stock move? So you can see over time, this is just a short period of time, like a month and a half. And I just want to show you, though, that on June 24th, they put out a press release that says they're having some senior unsecured notes that are due. So they have some debt due. And so they put this press release out that said this is what's happening. And you can see what happened was the stock price fell during that time. Not I mean, actually pretty much, like $4 a share. So that was kind of not so good. That whatever that, what that meant is they have notes, they have debt that they have to pay, and the stock market didn't really like it. It did recover, so you can see it did go up to the price it was before on June 24th, but it did go down. So what I'm trying to show you is that as things happen within the company, the stock market will react to it. So they didn't know about this unsecured, they knew, and then now the stock price dropped. And the thing is, though, that there's no way to anticipate these kinds of things. If you anticipate it, like if you're inside of the company and you figure out something's going to happen and then you trade on that before the market knows, that's called insider trading, and you can go to jail for that. So you can't, if you work in the company, you know something's going to happen that's going to impact the stock price, you cannot trade on that. It's against the law. So there's no way that we can anticipate something like this. But that is what happens with the stock market. You can't really know what's going on day to day. So this is one of the things, because we can't know what's going on day to day, the advice of many people is that you should diversify, so that when one stock goes down, the other will go up, and you can keep a steady growth in your portfolio over time without being sort of at the mercy of the risk. So I have I have several stocks in my portfolio. I have many, but I have these three: NextEra Energy, Chevron, and Snap. And you can see that when NextEra fell, Chevron didn't. It actually went up a little bit. Snap has just been bouncing around too. So what I'm just showing you is they don't move together, which is ideal. If we look at my portfolio as one, we want it to just slowly move up, not go up and down associated with the specific things that are happening in a company. So this is one of the main pieces of advice I think that are important when you're investing. In addition to investing long term, so I had you buy a stock at the beginning of this summer. I'm hoping you will continue to buy stock in a diversified way as a long-term investment. Just think, if you put $50 every quarter into the stock market, you might actually start to make some money by the time you graduate. So looking ahead at as a long-term investment is very important, and you should try to reduce your risk from one company's activity by diversifying and getting the market return associated with it. So that would be my advice about stock markets, but I hope this will help you analyze your particular stock too. So this particular section of this particular video was about personal financial decisions.